Let's explore exponential moving averages. Now that you've got a solid grip on simple moving averages, it's time to level up. In this lesson, we'll dive into the exponential moving average. You'll learn how it's calculated, how it compares to an SMA, and how to use it to spot both short-term and long-term trends. The exponential moving average, EMA1, is a moving average that puts more weight on recent price data. It reacts quicker to price changes than simple moving average. 2. Making it useful for short-term trading or fast-moving markets. EMA is designed to respond faster to recent price changes than a SMA. Instead of averaging all prices equally, the EMA applies a weighting multiplier to give more influence to the most recent price and less to older prices. Looks complicated? Don't worry about the math. Your platform will calculate it. However, understanding how EMA gives more importance to recent prices will help you trust its signals. Now let's see how it stacks up against the SMA. They both smooth out the price. However, the EMA1 is quicker to react to recent moves, while the SMA2 stays calm and steady. EMA is more responsive. Because it gives priority to the latest price data, it adjusts quickly when the price changes direction. This makes it useful in fast-moving markets, where early entry or exit matters. But this speed comes at a cost. It may give false signals during sideways or volatile markets. Let's say a stock suddenly jumps. The EMA will rise quickly to reflect that move, helping you jump in sooner. But if that spike is short-lived, it might overreact and lead you into a losing trade. The SMA moves slowly because it treats all prices equally. This makes it more stable and less likely to be fooled by short-term volatility. It is useful when you prefer confirmation over speed. For example, when you're following longer-term trends or avoiding whipsaws in noisy markets. Imagine a market that keeps bouncing up and down. The EMA might react to every small move, while the SMA stays more stable, helping you ignore the noise and focus on the bigger trend. Now that you understand how both the simple and exponential moving averages work, you might be wondering, which one is better for your strategy? The answer depends on how you trade. Traders use the exponential moving average when they need faster signals, perfect for short-term trading where speed matters more than precision. Meanwhile, traders choose the simple moving average when they are focused on longer-term trends, prefer smoother signals, and can afford to wait for confirmation. Not all exponential moving averages work the same way. Just as with simple moving averages, what matters is the period you choose. Shorter EMAs, 1, like 9 or 12, react faster and are great for short-term trades. Longer EMAs, 2, like 50 or 200, move more slowly and are better for spotting big-picture trends. Select the match. What does the exponential moving average period tell us? Different EMA periods reveal different insights. Can you match each EMA length to what it typically helps a trader understand? Balances short and mid-term trends. 50-period EMA helps confirm overall trend direction. 9-period EMA tracks quick momentum shifts. 21-period EMA Stock? It's time to explore crossover strategies. Great. Now that you know how simple and exponential moving averages work, it's time to combine them. In this lesson, we'll explore crossover strategies, powerful tools for spotting trend shifts and confirmations. Let's get started. Using a single EMA can give you a general sense of direction, but what if you want more detail? That's where combining two EMAs comes in. By comparing a short-term average, 1, with a long-term one, 2, traders get a clearer picture of momentum shifts and possible trend changes. When the short SMA crosses above the long one, it's often called a golden cross. 1. A bullish signal suggesting a strong upward trend may follow. When the short SMA crosses below the long SMA, it's known as a death cross. 2. A bearish signal that could indicate a downtrend. In an uptrend, a golden cross signals rising momentum. Traders often use this to enter long trades, add to existing positions, hold through small pullbacks, trusting the trend. In downtrends, a death cross warns of weakness. Traders use it to close or reduce long positions, enter short trades, avoid buying dips until the trend changes. But remember, these signals work best in trending markets, not sideways ones. Golden and death cross signals can be used with both simple and exponential moving averages. The classic setup uses SMA 50 and SMA 200, but many traders prefer using EMA 9 and EMA 21 for faster, short-term signals. It all depends on your trading style. SMA gives smoother, long-term confirmation, while EMA reacts quicker for earlier entries. What's your next move? You're analyzing a stock using the 50-period and 200-period simple moving averages. The 50 SMA just crossed above the 200 SMA after a long downtrend. Quiz: how would you respond to this potential golden cross setup? Explanation: not quite. A golden cross does signal potential bullish momentum, but entering right away without price confirmation can lead to premature entries. It's smarter to wait for the market to show strength, like a breakout or strong close above resistance, before jumping in. Now you know what a crossover is, but did you know you can also combine different types of EMAs to enhance your strategy? Using both the EMA and SMA together can help you balance speed and stability, giving you sharper signals and stronger confirmation in any market condition. As you know, SMA helps confirm the bigger picture while EMA gives you faster signals. When used together, they balance each other out, helping you stay in trades longer while still reacting to momentum shifts. The periods you choose affect how your EMA and SMA behave. Let me introduce you to a strategy that does just that: the multi-period moving average crossover momentum strategy. It helps you spot when short-term momentum breaks through longer-term trends, so you can ride big moves with confidence. This strategy combines a 9-period EMA, 1, a 30-period SMA, 2, and a 50-period SMA, 3. The 9 EMA responds quickly to price, while the 30 and 50 SMA show the broader market trend. You're looking for crossovers between the 9 EMA and the slower SMAs. When the 9 EMA crosses over or under the 30 and 50 SMAs, it gives clues about momentum and direction. When the 9 EMA crosses above both the 30 and 50 SMAs, it shows strong upward momentum. This is often a signal to enter a long trade, add to an existing position. When the 9 EMA crosses below both the 30 and 50 SMAs, it may suggest the start of a downtrend. Traders may enter a short trade, exit or reduce long positions, tighten stop losses. If the 9 EMA keeps crossing above and below the 30 and 50 SMAs, the market might lack direction. In this case, it's often better to stay out of trades, wait for a clearer signal, use range-bound strategies instead. Select the match. Match the market signal to the action. The 9 EMA is interacting with the 30 and 50 SMAs in different ways. Can you match each signal with the action a trader might take? Exit long or consider short trade. 9 EMA crosses above both SMAs. Enter or add to long position. 9 EMA crosses below both SMAs. Wait for clarity or trade ranges. 9 EMA moves back and forth. Stock? Excellent. Remember that technical tools are flexible. The same EMA SMA combo that works for one trader might not suit another. Don't stop at one strategy. Tweak the periods. Try confirmations. And build a method that gives you confidence in your trades. Congratulations! You've now mastered crossover strategies using both SMA and EMA. You've seen how to spot momentum shifts, identify trend changes, and respond in different market conditions. Now it's time to put your knowledge to the test with a quick quiz to reinforce what you've learned.